Well, welcome to another edition of Nucleus Investment Insights. Apologies for the late start. We had an exquisitely timed fire drill here which I thought we might avoid to getting through on the speaker. So today we are talking about the future of fossil fuels. So a big report out from IEA this week, just sort of running through some of the key factors in terms of what's happening with fossil fuels. And also we have Liberal Party discussing whether or not they will decide to drop the their own they'll drop their own net zero and everything like that going on. So I thought it's well worth jumping into how we're treating it from an investment point of view. And so just a quick reminder as well, everything you hear today is general advice in nature, none of it is personal. And with that, we'll jump straight into today's show. So let me just find my my notes here. So I thought what I want to do is sort of approach this from a few different angles. I thought what I'd do is run through a little bit of the background behind this, talk about some of the geopolitical issues, and then we'll look at the IEA report and some of the forecasts that they've sort of changed and what they're sort of suggesting in terms of consumption. And then I want to talk about sort of the three big fossil fuels in terms of coal, gas, and oil, in terms of how we're looking at it from an investment point of view and how you should be thinking about what fits into your portfolio on both a short and a long-term view within that. So I thought I'd start though with this background to say, look, there's sort of three main points that I think in terms of how we approach it. Is that, look, climate change in our view is real. All the numbers certainly support it, and last year was another record year another record year in terms of the global temperatures, but the water is muddied by vested interests, and we're going to see that the big companies involved have certainly been very successful in terms of changing the debate to about when should we do this, and do we want to give up? What do we want to give up, and what don't we want to give up? So that's one part. Secondly is fossil fuels are absolutely still required right now. There's under any of these scenarios, even sort of the net zero, quite aggressive net zero ones, you still need fossil fuels to get you through that transition phase. And we don't think there's any political support for offering a big step back in terms of people's lifestyles in order to get to that net zero. We do think it needs to be managed, and so there's going to be a demand for fossil fuels of some description over the time period. But the investment incentives are incredibly skewed for all these coal, gas, and oil in different ways, mostly against some of the longer term projects. So the idea that because of all the uncertainty, it's very hard to sort of put a project in, a 20, 30, 40-year project in for some of these, which is what used to always be done. And so the investment incentives are all going to be skewed, which is going to mean that there's all these different factors coming into play for investments about how you should be treating it. The third point is electric vehicles are here, and the whole electrification is happening at pace. Having said that, the buts for the electrification is it's going to take a long time to displace oil, particularly for electric vehicles. And driverless cars is a little bit of the wild card, and we'll talk a little bit about that later on. We have talked about that in prior podcasts. So that's the background with which we were approaching this. Secondly, then is the geopolitics of it. Now, that in this sector makes more of a difference than pretty much any other sector. So, and this is pushing in all different directions. So the biggest ones is Russia and the Ukraine and what's happening there. So the idea is you can go either direction with what you're looking at here. So if you get a resolution to the war and some sort of negotiated peace with Russia getting a bunch of Raj, we're getting a bunch of things from the rest of the development world in order to come up with a resolution. Is you could see the world flooded with oil, potentially a little bit of gas. I do think the gas is probably going to be a much harder one to turn back on Russian gas. But Russia is a major producer of oil. If you get some sort of resolution, which basically involves Western countries agreeing to buy Russian oil in return for a negotiated peace settlement, then you could see this situation with lots and lots of oil floating around. The flip side is if you get you don't get a negotiated settlement. And we're seeing significant increases or improvements in drone technology at the moment. Is you could see a large part of the Russian oil taken out, and we have been seeing that in recent months. Ukraine certainly targeting and being much more successful than what you used to be at targeting refining capacity within Russia. Russia also has a shortage of technical knowledge. A lot of the increases we've seen in Russian oil production in the last sort of decade or 2 decades have often been driven by Western countries, which are no longer operating within Russia. So Russia's got the problem insofar as there's some tipping points where if a certain amount gets taken out or certain enough gets taken out of some of the production, it's very hard for them to get back online because they just don't have the technical capability en masse to be able to do that. And that also go through to sanctions as well. So it is potential. We can see oil prices rising because Ukraine's been successful at targeting Russian oil, or we're seeing further sanctions sort of pushing out. So that's your big geopolitical issues there. In terms of China, I think the way you should be thinking about China's consumption and how they're treating fossil fuels is China wants to be self-sufficient in most of these in energy. They don't want to be and lots of things. That sort of a bit of a guiding principle is they don't want to be reliant upon other countries. China has got a lot of coal. It's got some of the world's biggest sources of coal. So that's sort of one area which I don't see China cutting back dramatically in terms of what it's doing in terms of coal. It doesn't have a lot of gas. It doesn't have a lot of oil. And so it does want to sort of move away from those technologies and more into coal. It's been beneficial for Australia insofar as I think the way China's been looking at it is, yes, we can build coal-fired power plants and we're building a lot of them. We haven't, our coal mining hasn't actually kept up. And so we need to import this from other countries, but eventually the coal mining can catch up and at that point, they won't need to be importing as much from other countries. And so, I do think from that perspective, there's coal demand, but it's a sort of weird type of demand in that it's a relatively short-term demand that's still being kept up. And at some point, if China stops importing masses of coal, that'll make a huge difference for the rest of the world. And then as part of this whole self-sufficiency, big in wind, big in solar, big in electric vehicles. So that's been this real push in terms of China and in terms of technological change. That's a real factor that's sort of going to go into to what's happening and affected globally in terms of say oil demand, because the amount of electric vehicles being produced in China, sold in China, and exported to other countries. Europe is sort of a bit weirder in terms of their geopolitical side. It's sort of negative for gas in some ways, insofar as they were a big consumer of Russian gas, and that's largely been all switched off, substituted for US gas in the short term. But they're certainly very much trying to move away from that. Wind and solar, big positives there. And a real question mark around EVs. They're certainly lagging China in terms of EVs. They do have a lot of car companies and a lot of sort of domestic manufacturing that sort of that I think there's political will to protect within Europe. And so the question about how fast they take up electric vehicles, lots of question mark over that. And even some of the countries that have been leading the way, often Norway is sort of pitched as one of the ones leading the way, and it's a bit of a weird one massive use and sales of electric vehicles, but it's largely it's also one of the world's largest oil producers, and in a way, all they're doing is effectively using other people's purchases of oil to drive their own cars in order to subsidise electric vehicles in Norway. And so that doesn't feel like a vision of the future as much as it's a substitution effect, or maybe a guilty conscience that's sort of driving that. So I really do, watching Europe for how much support behind electric vehicles and how much protection they're giving their own local car companies versus Chinese car companies is going to be pretty key there. And then the big one, US, obviously we've got Trump there, negative on wind, solar, electric vehicles. He's actually, the net effect, in my view, is he's actually negative on coal, effectively anyway. While he might talk up coal as being, the positives around that, the fact that he's also positive in gas and oil, basically is pushing out coal. Coal in the US is a bit of a weird one in that they've got some really cheap coal in some of the middle, the sort of left-hand side-ish parts of the US, but it can't be exported because there's sort of wide-scale aversion to ramping up into the ports on the West Coast. So most of the West Coast tends to be relatively liberal, whether you're talking Portland, Seattle, California, and they're generally against trying to expand any of that coal. So the cheap coal in the US is sort of stuck within that, and the more expensive coal on towards the West Coast and middle of it is being displaced by the really cheap gas that's in the US. And so that's sort of that's why the gas side is a bit more positive. But the bigger issue for gas is that the US is very busy building export plants and liquefaction in particular. And so they've got really cheap gas prices in the US, and that's going to the cheap gas prices in the US are going to approach closer to the world gas prices because they're building these export terminals to get things out there. So that's your geopolitics we're thinking about. Oh, sorry, and there's also, I guess, within the Trump part there's the positive negative that you're looking at in terms of the pendulum certainly swung a long way towards the fossil fuels at the moment. It does seem likely that at some point it'll swing back the other direction when you get more the Democrats get back into power. But the question is, then do you just swing back at some point? It's you're switching between these two quite extreme regimes there. There's not a lot of consensus around a sort of a more centralist path within it. Whereas I think within Europe and China, there's much more consensus around a more centralist path, or what the path is forward for fossil fuel use. Right, so that's those. Then I wanted to run through some of the so that's sort of setting the scene of the big picture thoughts and the geopolitics that are at play here. Then I thought I'd run through some of the key charts that IEA has put out, which are quite interesting in terms of how they're changing, and I think they speak volumes as to where the real pressure points are within all these technologies as to what's happening. So we'll jump to those, and then I wanted after that, then we want to jump into the individual ones, and then how to do that. What's happening in terms of investment perspective for all those. So so jumping back to some of these charts, let's have a look at the first of all. There's 3 different scenarios that they're considering within this report. One is the current settings, and that's shown on this chart on as a red line. The second one is the stated goals for countries. And then finally, it's not shown on some of these, but some of the other ones you'll see a net zero. So the CPS you see on any of these charts is what's the current settings. The STEP is the stated, stated or expected from that. And so the idea is within this is some of the changes they've made is they're just noting that there's a reasonable amount more total energy demand needed under the current settings as opposed to the stated ones. That actually there's not a lot of change in terms of electricity demand. So basically the their expectations for electricity demand is relatively consistent, whichever scenario you take. It's just that if you keep going with the current settings, then there's a lot more fossil fuel use outside of electricity. And then finally, this idea of the renewable share in electricity generation and how much renewables make out, based on the sort of stated versus what the current settings are. And then that flows through into how that affects each of these. So the big message, I think, for coal is, from what we can see from this, it's talking about the billion tons of coal used, and it's the noting is it's pretty negative either way. So what we're looking at is you're either dropping from current levels and cutting out 20-30% by 2050, or you're going to be halving it under the stated ones, and the net zeros drops even more dramatically than that. So either way, what coal is really about is a managed path. How's that path being managed? How steep is the decline going to be? And there's not a consideration within these of any sort of increase within that. And so that sort of we'll talk about more in terms of how you're approaching your investments, but it's really about managing that downside in terms of coal. The next charts they have is the oil side, and this is again the real swing factor around this is that under the current scenarios, we're talking about adding another 10-15% more oil demand. Under the stated ones, you're talking about taking off maybe 5% off oil demand, and then under some of the net zero ones, it falls quite dramatically from there. And so it's a real swing between, do we need more or do we need less? And the other factor within oil is the production schedule for oil is quite different to some of these other technologies in terms of how fast it drops off. And so I'll move into more detail in terms of oil, but really what we're talking about oil is quite significant changes in demand, depending upon how much you believe current policies are going to keep going versus going to stated policies, and then under net zero, that's a much faster drop off again in terms of oil. So there's that. The natural gas side is really talking about whether that's going to expand under the current settings and expand quite markedly. So you're talking about sort of not quite a 50%, maybe a 30-40% increase in terms of the amount of natural gas needed, versus the stated policies, which is increases for the next 5, 6, 7 years, and then sort of this gradual fade off of what's needed in terms of the gas. And for me, there's probably that's probably the one where if you look at some of the technological changes and just sort of demand factors, is gas really does seem to fit as one of the things that could you could see more demand coming on than what you might expect out of that area. Then I do want to note within these, there's and I don't want to harp on climate change too much, not because I don't think it's extremely important and it is worth noting, but I think there's we're here to talk about the investment side of it and what do you do under these scenarios. But I do want to note that under the current settings, we're talking about almost 3 degrees by 2100. Under the stated ones, we're talking about 2.5 degrees. Either one of those doesn't sort of fit with I think what social expectations might be. I think there's certainly a social expectation. I think in a lot of these that actually we shouldn't have 2%. At 2%, some really weird things are going to start happening, and we need to sort of limit those limit how much that is. And so there's that real downside you can get in all these if you do get political will switch to more of a net zero over time. So net zero is sort of almost being treated as a bit of an outlier case in here, but I think within any investment you need to really consider this as a your tail risk is you get a widespread switch in social expectations towards that, and that can really damage the investment outlook for all these. Because I think the investment outlook for a lot of these fossil fuels is, look, if things keep going the way they're going, there's some reasonable investments to be made within this. And even under the stated policies, you can get in some of these fuels, you can still see some, or gas in particular, you can still see some reasonable growth needed. But if you switch to a net zero, then that's a significantly negative for the investment case for all these. The other bit, there's another interesting chart which they've got just talking about where the demand is coming from, in terms of energy demand. So the charts we're showing is talking about it's got four different lines for each sort of section, and broken up into where the demand comes from. The first one's population growth, and it's talked about, the first line is 2000 to 2010, then 2010 to today, and then the next 10 years, and then from 2035 to 2050. And it's talking about the annual expected growth in it. So population has sort of grown at 1%-ish, and that's expected to fade off over the next sort of two decades. That are still a factor, still a growth factor in terms of use, but shrinking. Cement dramatically lower in terms of where it was. So talking about almost no growth in terms of cement. Plastics. Now, plastics is an interesting one. Some reasonably high growth expected for the next 10 years, but fading off from that. Cars, there's still a lot of expected growth to come out from cars, and I think a lot of that is expectations that you'll be looking at developing markets, just a much higher need for cars within places like Africa and India over time. Aviation, still some reasonable growth. Appliances, heating costs coming off a fair bit, but cooling costs, cooling or demand, I guess, in terms of cooling is a significant increase there. And that's again as developing parts of the world hit the stages where they're getting to the part where they can afford cooling, but also the thought that in a hotter world, more places are going to need cooling, and the demand for heating is going to shrink away. And also as part of that, the less developed parts of the world tend to be the hotter places, and the more developed tend to be the colder places. So there's that the reduction in that, say Canada, for example, it's probably going to be a bit warmer, but it's also quite a developed country, and so there's probably not a lot of growth in terms of heating needed within developed countries like that, or most of Northern Europe. One of the actually, I'll skip over this next one. It's probably more, certainly within what we're talking about. Oh, sorry. Actually, no. Sorry. This chart is showing the same sort of factors, but what it's really talking about is the difference in if you're talking about the current policy settings versus moving to the stated policies. There's not heaps of difference between the two measures. It's relatively minor, I guess, the drops between them. So I think there's the actual breakup of it is not that different. There's also I think they address two of the individual technologies. Is if you look at advanced economies and retail or household consumption in particular, and say, well, where's the big change in terms of household? In advanced economies, it's really about EV charging. There's not a lot extra in terms of heating or cooling. And I think within advanced economies, even some of those you might be looking at in terms of saying, actually, the space cooling, for example, in a lot of advanced economies is actually probably going to be improving. You're probably going to need less of it because of improvements in technology. And then you get a little bit at the margin sort of picking up in terms of extra ones in new countries that are going to need cooling that might not have otherwise needed cooling. There's a number of days, say, in northern US where you actually need to cool your place will just be higher than what it's been in the past due to the global warming. Whereas in emerging markets, it's actually mostly about that heating and cooling. That's the as countries get warmer, as countries get richer, the greater demand for those technologies. Sorry, just keep going on. I think there's some interesting parts in this, and this we'll wrap up. This is the last one about the IEA report that I wanted to address, but it does sort of flow into the investment views for later ones. So the next one then is talking about the electricity consumption in data centers. Obviously, the data centers is this there's this huge demand factor at the moment in terms of data centers, but what I really wanted to highlight was that, as we've been speaking in prior weeks, this is largely about the US in particular, where this is a chart just showing over the next sort of 25 years, over the next 6 years, where's the demand growth coming from, and how much of it is coming from data centers. So 50% of the demand growth in the US is expected to come from data centers. But if you look at China or emerging markets, it's really a negligible amount of the electricity demand. Most of the electricity demand is coming from other sources within those markets. Even if you look at other advanced economies, it's sort of going to be probably around 25% of the demand is going to be from data centers, whereas most of the rest of it is from other sectors. And where does it come from? Well, non-EITs, non-energy intensive industries, is the biggest growth. So a lot of this manufacturing type things, appliances needing a lot more power, electric transport is actually, as you can see again, that switching to EVs is just not such a great increase in electricity. And then, flowing down that. So in order for anyone listening into the podcast, the order is basically manufacturing and appliances making up most of the growth, then transport being third, space cooling, data centers, heating, that sort of make it up before you get to the energy intensive sectors, which tend to be things like cement and oil refining and things like that. So data centers really important in some areas, but actually just not that important as an overall factor, despite the fact that they're going to increase quite substantially in terms of the amount of power that's being used within that over the next 6 years. So that sort of sets the scene about where these demands are coming from. Now, I've spoken about the IEA as being, about talking about these forecasts. It's worth noting that with any of these forecasts, that it's just these are all just guesses, not guesses. They're educated expectations, and really it's about the idea, less about the idea of are these going to be right. I can guarantee you they won't be right. That there's going to be big differences between them, but it's really about talking about what can we see at the moment, what are the expectations, what's being built, what's not being built. And can we work into that a model that actually sort of says, well, how much are we going to need of these extra fossil fuels, or how much are we going to need of these new technologies? What's the sort of base case at the moment, and putting it into based on these, what's the trajectory look like? Because from then it's a question of where that goes and what that means within those. Okay, so we're going to jump to a quick message, and then we'll come back and talk a lot more about these individual fossil fuels and what it means for those.
We'll be back with the investment insights very shortly. Nucleus Wealth is an active and passive investment manager. If you like what you're hearing and want some help with your investing, we can do it for you via our active portfolios. Our tactical and core portfolios use the insights shared in this podcast to construct and manage your investment. We blend tactical portfolios to offer our combinations of international shares, Australian shares, government bonds, and cash. We vary the asset allocation with the goal of protecting your capital in times of market uncertainty. We also have active international and Australian share portfolios. These are chosen using our quality and value investment philosophy. You can find out more at nucleuswealth.com. Now back to the show.
Right, so before I get into the individual ones, what I want to talk about a little bit is the costs involved. In my view, energy is a technological battle. It's really a question about what are the costs and unsubsidized costs. Yes, subsidies can help switch into faster or take you slower, but what's really important is unsubsidized costs. Where do they sit, and where's the technology going within these? So the big picture sense is that, and I've got just a chart up of solar versus coal. Now, yes, I know solar's only lasts us half the day, and there's all these other issues with it. We'll get to that in a minute. But big picture wise, really what we need to keep into factor is solar really didn't matter for the last 50, 60, well, the last forever, until early 2010-ish, 2010, 2011. All of a sudden it became an issue that actually that the costs have caught up on an unsubsidized basis. And that was really what is that important part, is that solar's on this technology curve, and most of these other technologies, so coal and gas, are on a scarcity curve. What's more important, I've got another chart just sort of showing these costs over time. What's more important is this idea that if you've got utility solar plus battery and you're doing some partial shifting or you're doing some full shifting, is that where does that sit versus these other technologies? Yes, sun doesn't shine at night. Wind is intermittent. We need technologies that can that can store the energy if you're going to be using these as your key ones. So the blue line I've got in this chart is your solar, and keep in mind this is just from 2010. This is just the last 15 years. Is your utility solar plus battery with full shifting, which is sort of your key part. The yellow dotted line is utility solar plus partial shifting, so basically taking a few hours of getting through the evening peak, and what those costs are. And so those costs just keep coming down. Now, we're not yet at the stage where they're beating the costs for coal or gas. In most markets, there's some markets where it's expensive, coal's expensive, gas is expensive, and solar and batteries are cheap, and you can come up with that argument that does work. But generally speaking, we're still not there. Having said that, it's this is a technology battle. So you've got to come up with the expectation that we're not going to get there, and that these lines are all of a sudden going to stop or freeze or something like that, and no longer keep going down. I think is unrealistic. We've seen in these, the technology for solar is very similar to the technology for computer chips, and they've spent the last 50 years falling in price. Solar's spent the last 50 years falling in price, and the more you do, a lot of it's just the scaling up. The more we do, it's hard to come up with a reason why that's all of a sudden going to stop falling. The real key though is actually not solar. It's more about the batteries. Sorry, no, I actually haven't brought up the one of the key lines I wanted to show here, which is the idea around that what's less important now is solar costs, because solar costs have fallen so far that they're no longer they're now so far below the cost that even if they halve again, it really doesn't make a heaps of difference to the overall cost. It's actually all about the batteries and the cost of that batteries and shifting shifting that power. So within that, the idea is there's this is that how do we get that? Is the battery cost going to keep falling over the same part? And again, battery costs are coming down significantly. They keep falling year after year. No, we're not yet at the stage where you'd unequivocally say they've reached the level. And so, but again, it's very hard to bet against it. And so, and we certainly saw in the last couple of years that at Russian invasion prices, and that was that chart, the line that sort of popped up on these, where we saw that jump in the coal price and the jump in the gas price. If at those prices, then all of a sudden solar plus battery is worth it. And so, if you have to pay $400 a ton for coal, or you have to pay $15 or $20 per million British thermal units for gas, then solar plus battery is all of a sudden in the lead on these. So the other thing to note though as well is that the level of a different way, is the fuel cost for these for coal and gas actually make up the lion's share of what the cost is. So within that, if you're talking about, if you can get coal at $50 a ton, for example, then it will look significantly better than so sorry, how can I put it another way? So coal at $50 a ton is probably talking about 6 cents per kilowatt hour. It would be your production cost at $50 a ton. If you can get coal at $200 a ton, you've basically you've approximately doubled your overall cost. So huge difference in terms of that cost. Natural gas actually makes an even bigger difference in terms of the fuel. So a lot of the natural gas plants are actually a lot cheaper, and so they're a lot more reliant upon the fuel cost. So if you're in the US and you can get cheap gas, that makes it look way more effective for you than if you're somewhere like Europe where cheap gas is not as available. Okay, so that's our sort of overall feature on costs. Then I want to sort of tie that back into that chart we spoke about where that demand factors we've got those demand factors falling away. So for coal is some quite dramatic falling in terms of those demand factors. And so then let's move on to coal. So if what we're looking at for coal, in broad senses around coal is it's really a regional argument. Coal is very hard to transport over long distances at an economic rate. Per ton of transport, it's just expensive. You can double the price. If you've got cheap coal and you can take it straight out of your coal in, say, somewhere like Australia and put it straight into a coal-fired plant, versus shipping it somewhere overseas, say to China, you can sort of double the cost of that coal because the transport costs are so high within it. You've sort of got these two parts to where China and India have got a reasonable amount of coal, and China in particular is still expanding what they're using. The rest of the world, though, is pretty much rapidly reducing upon what they're doing. There's some arguments around how you should be building systems at the moment, and that's sort of worth noting that in places like Africa in particular, to a certain extent in India as well, there's this part about saying, do you just build a decentralized electricity grid? So rather than the old model, which is you build a big power plant, whether it's coal, gas, nuclear, whatever, and then you build lots of transmission lines and ship them everywhere, or do you just put in local ones? And that tends to be more about that's where solar and wind and batteries really tend to shine a lot better, because all of a sudden you don't have these big transmission costs as well, which sort of brings it down. And it's the question about, Africa really went on the telecommunications front. It sort of went down that same path where 10, 20 years ago about saying, well, actually, rather than building out this big fixed line telecommunications one, they're just going to skip that stage and just jump straight to mobile and a more decentralized, cheaper to build mobile towers and to ship it to use telecommunications in that way. And the question is, are they going down that same route on coal and more renewable energy? And at the moment, it does look like that's a pretty reasonable bet that's the way it's headed. Not to say we won't see changes there, but yeah, that looks to be the new model. And I think in a way, there's what's been happening in Ukraine and Russia is actually sort of pointing a little towards that. Shifting people a little bit in that direction anyway, in that when you look at the things Ukraine's been doing to try and safeguard its electricity network under military threat from somebody else, you've in fact from Russia, you've basically got this old version where you had lots of coal and lots of nuclear plants. Now, the coal plants are a target for a military target, and you can cut out a lot of electricity by tracking some of those. Whereas renewable energies and batteries tend to be a lot more distributed and a lot harder. And so, there's this idea about should you be actually building you're if you're putting together a more modern electricity network, there's both military reasons to do a more decentralized one, as well as the economics are starting to end up being line ball, and if the future economics look better, then that's another reason you sort of head in that direction. So in terms of coal, we're really looking. So that's where we're looking from there. In terms of Australia in particular, what really helped Australians coal prices and coal exports was China 20 years ago flipping from being a net coal exporter to a net coal importer. That was what really made the big difference, because all of a sudden Australian coal went from having a reasonably large competitor in the world markets to all of a sudden having a reasonably large customer from the same place, and that's clearly got the potential to reverse at some point as China keeps growing out its a renewable source and keeps growing its own internal coal production. Yes, they're still putting on coal-fired power plants, but if they can deal with that internally, then that's going to make a huge difference to the export market. And so from an investment point of view, you really need to take a view on what China's doing and whether that's going to, because if that flips and they stop becoming an importer, then that's going to make a massive difference for any investments in the coal sector. The US, as I spoke about before, has got a lot of cheap coal on the sort of western-ish side of the US, but it just can't get out. So probably and probably just going to see that US coal will continue to shrink, largely driven by US gas being so cheap rather than renewables. So not a lot I want to be looking at from that perspective. And then other areas of the market, really it's really a question about in terms of Europe and Africa and India, about the growth in renewables versus coal. So really, how I look at the coal market is a question about, well, look, if you get particularly low prices in the coal market, it may be worth investing in some of these coal companies. I think if you've got, and we're not seeing particularly low coal prices at the moment, they still are relatively high. I think there's an argument for investing upon expectations of disruption. So if we're not going to have enough, you're going through this period where you can't get enough gas or something like that or you get more breakdown of Russian gas or breakdown of, say, some large exporters of gas within the US or flips within that, then there's a reason for coal. But X sort of issues in other areas, it's really about managing that downturn in coal, and it's not an attractive growth outlook. As a long-term investment, more of a situational play if you think there's things happening within that. Gas is a different market again. Within gas, Russia, the real big story within gas was Russia going from being a really big exporter to Europe to effectively exporting almost nothing through to Europe now. There's a bit that goes through Turkey, but all the northern lines have all ceased, and there's that's taken a huge chunk out. The US has sort of stepped into the gap with some big expansions of what they're doing in terms of liquefying gas in the US and shipping it across to Russia. We've got a few plays that we've been looking at within that, where it's basically taking the view that there's going to be some normalization in terms of the cost. So really cheap gas in the US, expensive gas in Europe. As more and more export terminals get built in the US, that'll normalize that. And so you'll get some sort of convergence on it. And that's been working reasonably. It's certainly over the last, this is a sort of medium-term play. And we've certainly seen some gas price rises in the US from some of their lows. But it's it's really at the margin within that. The efficiency of gas versus coal is quite good. There's still this phase, particularly in the US as well, where we're looking at lots of those data centers. We saw that 50% extra electricity demand from data centers that's a pretty attractive target for further growth. Is that you've got some gas, really cheap gas, particularly in the middle of the US, sort of sitting there coming out of the fracking technologies they have. And if you can hook up a gas-fired power plant there and stick your data center nearby, is you can be some reasonable growth in terms of that is quite it's quite possible to look at. The other big exporters, you're looking at Qatar with some expansions coming through, probably no more expansions or no significant expansions coming through from Australia on that front. So most of the action really for us seems to be within the US. There's what was the other question with that? Oh, sorry. The other one is Russia's got a lot of gas potentially, and this comes down to Ukraine resolution. If you saw again a relatively or a negotiated end to what's happening in Ukraine from Russia's point of view, where Russia negotiates a lot more access to markets for its gas, and say access to technologies from Western countries to set up more liquefaction plants to ship more of it to China, things like that, then that could be a positive for gas. But that's certainly not our base case. I think within our base case, it's more about and when I say positive for gas, it's positive for gas supply, probably a negative for gas prices. So if you're investing in a company like a Woodside with a view that, look, if Russian gas stays offline, it's more of a positive for gas prices, but then if Russian gas comes back on, it's a negative for people who are investing in these companies. And then finally, this idea that there's this, most of the gas is really, it needs to be liquefied and sent, and that's quite an expensive process. It adds another few dollars to, sort of $2 or $3 to your gas price, which means if you're sitting in the US, it's adding sort of 50 to 70% higher gas prices than what the US is. But when you've got high gas prices in Europe, it's much smaller. If gas prices in Europe are sort of in the $10 to $15 range, then $2 or $3 extra for liquefaction isn't a major issue. It does, though, sort of point towards, particularly in Europe, that renewable energies all of a sudden look a lot better because they're just facing not as much competition. Whereas the US, if you're setting up wind plants or solar plants, you're competing with some really cheap gas coming out of the ground. Oh, sorry. And the other factor with gas, particularly in the US, is gas for a lot of the markets, particularly some of the more southern sort of Texas-based oil production. Gas is really a byproduct. So what's happening, and what I mean by that is when they're drilling wells, what they're drilling for oil, and the gas that's coming out of the ground is sort of makes up 10%, say, of your overall revenue. So you drill for your gas. Yeah, certainly I'm going to use the gas. I'm not going to throw it away. It's 10% extra revenue that I wouldn't have otherwise got. But you wouldn't be actually drilling that well for gas alone. You're drilling it for the oil. And so the issue you're facing is that the gas in the US really does depend upon the oil price in the US more so than elsewhere, because higher oil prices effectively end up meaning lower gas prices, because higher oil prices mean more oil production, which means more gas production, which pushes the gas price down. And conversely, if we see lower oil prices, actually there's probably going to be less gas production, and so that gas, which means gas prices are higher in the US. And so the question about what that means for the markets you're investing in, it sort of makes a huge difference. So that's your gas prices. And then finally, we sort of move on to the oil side of this, and then we'll talk about the investment part at the end. What does this mean for investors? So oil, big picture oil, it's cheap in the Middle East, but probably not a lot of expansion going on within that. It's expensive offshore for oil. But again, not a lot of expansion, because the projects you want to do offshore, 30, 40, 50-year projects, very hard to get up at the moment, with a view that, look, is there going to be enough oil around? And what we spoke about, those two different scenarios, one where oil's growing, the other one's shrinking quite dramatically. You have rapid declines in oil fields versus other ones, particularly, say, versus coal. If you have a coal mine pretty consistent production from year to year, whereas in oil, it's some rapid declines, and particularly in the US. The US fracking completely changed the whole industry, because if you're looking at saying, a 50-year project of some offshore oil, you have to make a huge bet on where the oil price is going to be in over the next sort of 40, 50 years. Whereas in the US, fracking projects tend to get most of their revenue in the first 2 years, maybe, and then a bit of tail off over, say, 5 years. It just means you're taking way less risk. And so the question, if you're an oil company, is, do I go, if you've got two different ways, I want an extra 1 million barrels of oil, or I want an extra 100,000 barrels of oil to produce, I can either do that from production facilities in the US, where I'm taking a bet over 2 to 5 years about where oil prices are, or I can try and make a bet on some offshore property where I'm making, say, a 50-year bet. Obviously, a much bigger, or it's much easier to do it as a US. And so the key thing for oil is really these timeline issues. Two big factors. One is the timeline issues, disruption. If you your own production and you go through these lower prices and nobody does enough investment, then maybe there's these you can get these sudden rushes. We get that through. What happens in Russia? A massive swing factor, one way or the other. So really, for oil, the investment side for that, it comes down to saying, are you can you do you have an option on disruption? Really, are you producing at low enough prices you think you can sit through most of this cycle? And can you, if things extend, electric vehicles don't come in as fast as expected, Russian oil drops off, Ukraine is much more successful at targeting Russian production. Have you got some optionality in that for these events, which can give you some upside? And then what are the right levels to be buying that at? And we'll talk about that a little bit more after this next message.
We'll be back again shortly. If you like what you're hearing but want a low-cost passive option, Nucleus Wealth is the first to offer passive direct indexing in Australia. The first generation of passive investing was index funds. The next gen was ETFs. Now direct indexing is here with significantly more customization and control. The benefit of direct indexing is you can add or subtract investment themes, and we have almost 100 different options to choose from. For example, you could buy an international share direct index portfolio that excludes fossil fuels and arms manufacturers and has a tilt towards cybersecurity and cloud computing. Alternatively, you could buy a portfolio with no screens and an extra exposure to nuclear power and defense contractors. You can find out more at nucleuswealth.com. Now back to the show.
Okay. So, first thing I wanted to get back into was actually just the investment side. So I wanted to talk about the investment outlook. How do you play this within your portfolio? First thing is, because these are quite large sectors within the market, and they're also sectors that people can have some strong personal feelings for and against. We have what we call tilts and screens for investors, where they can get in and change these themselves. So within the climate change category of the screens, a few different key ones there. The no fossil fuels worst offenders, the no fossil fuels any. That's sort of key way that people use to knock these out of the portfolio. And then there's some other ones there about coal seam gas and nuclear power. So that's if you want to exclude these from portfolios where Nucleus might be including them. And then the second one is adding in more of these, and there's a bunch of different ways to do that. Most of them sit under the commodities factor, but you can add in within there. There's more oil and gas stocks, coal stocks, uranium. There's oil futures. There's some gas futures in there as well. All ways you can sort of add extra into your portfolio if that's what you're looking for, is to try to get that exposure to some of these markets. So that's sort of the big picture about how you can modify what's going on there. In terms of what Nucleus is doing within our portfolios, sort of our active portfolios, is there's sort of three parts to this. On the coal side, look, we've been avoiding that. Prices are still high within coal. I'd be happy to invest at I don't know, $40 a ton, $50 a ton, those types of low prices. If I thought that there was a reasonable window, and particularly if I can see issues about disruption in other markets, there's investment for that. But really for me, coal is we need to see much lower prices before I'd be interested in coal. It's in a runoff. It's really about a question of how fast that runs off, and looking for companies there that aren't going to be subject to that runoff as much. Within gas, for us, it's about the US optionality of this. There's some companies we've got where it's about that taking that gap between the US prices and the European prices from two different angles. One is that the demand for data centers is going to drive greater gas within the US. Sorry, three different angles. One is demand for data centers. Secondly is as we've got a lot more export terminals coming on in the US, and so that's just going to mean more gas exported from the US and more into Europe, which is going to lower European prices and raise US prices. So we want to be on that side of that. And then so that was 1, 2, and then the final one then is oil prices haven't been particularly high. And because oil prices haven't been particularly high, we think the supply side is going to be reduced a little bit on that side within the US relative to where it might have been. And so, again, one more reason to see US gas prices that little bit higher. So some factors within that. And we do think as well, gas is probably one of the more likely ones. If you took the view that, and I think this is sort of where we're coming from at the moment, is that there's going to be, in the short term, there's probably going to be more fossil fuel use than people looking from a climate change perspective would prefer. It probably does mean a catch up at later points. So more fossil fuel use now, and then a sharper tail off of these technologies from 2030 plus is I think what is a more likely outcome. And particularly from a political point of view, but secondly we really just have this rush of power needs at the moment, electrification needs. Can our electricity and switch to renewable energies, can that handle the switch to EVs? Absolutely. I don't think there's a major issue with that. Can it affect more data centers? Yeah, it can get more data centers. Can it get this whole switch of less gas in the US and less Russian gas in Europe and more US gas, and this changing of that? Well, now we're starting to get to the stage where it could have, but we're starting to stack things now where, could we have handled more air conditioning and more cooling in developed countries? Yes, we could. But now that we're starting to add all these on top of each other, the demands for extra power over the next sort of 10 years is going to be a lot higher than I think anyone was expecting, and that the data centers is sort of like the icing on the top, and just one extra that's going to push it. And I do think that means that more demand for fossil fuels over the next decade, and I do think gas is the most likely source of a lot of that. Within that longer term, I think that probably means the sharper the rise, the sharper the fall at some point. But over the next sort of 5-10 years, the demand certainly looks like it's relatively high. And then finally, oil. It's tough, hugely geopolitical. Russia is the real key rather than the Middle East. Negotiated settlement that basically means developed countries back buying Russian oil is really going to be a negative if you're investing in oil producers. But the flip side is, and it doesn't look like there's any negotiated settlement coming anytime soon. The other thing to watch, though, is increasing targeting and really watching Russian oil production, because the more that gets taken offline, the more China's going to need to start competing for other oil. So low oil prices, we're in as a buyer. Oil prices higher, we're not. And Russia is really that key factor we're looking at. And what am I talking about? Low oil prices. Look, at $20 or $30 oil, yeah, I'm jumping in. It's too low at those prices. Between sort of $30 to $60 or $30 is sort of the middle range, and getting above 60 is starting to talk about, okay, where, how much higher can it go, and is that sort of starting to drive demand factors. So so that's sort of how we're looking at these factors. I think looking upon the IEA report and their discussion is quite a the real thing that they're refocusing on within that is sort of the three factors. Based on the way things are currently going, we're going to be using a lot more fossil fuels than some of the prior plans from a few years ago, and that's been a political push. There may well be a political push back the other direction at some point, but the political push at the moment is certainly more fossil fuels used, and that means something for investors. And then that question about that hanging over your head. So anything that remotely approaches net zero will require a sharp drop off and a much sharper drop off in that, and that's basically going to be post 2030, probably post 2035, if that happens, and that's a huge negative for these if that's where the political will sort of is going to push things. So that's all I really wanted to comment on that. We haven't had a lot of questions today on this, but thanks for tuning in to Nucleus Investment Insights. If you found insights today, help us by giving us a like and subscribe so you don't miss any future episodes. If you've got any questions, pop them in the comments. We'll answer them on our socials. Don't forget to catch us live for the next episode, Thursday at 12:30 Australian time. For more insights, visit our website, sign up for our weekly email to get updates straight to your inbox. And if you'd like to build a personalized investment portfolio, take advantage of some of these tools we've shown you in this, head to our website to start your risk-free account, send us an email, or book a free consultation with one of our team. Thanks, and we'll see everyone next week.